Hello, I'm Joyce Tan, the Head of Fixed Income Singapore at UOB Asset Management. My team and I manage a suite of SGD Income Solutions. This includes the flagship United SGD Fund, which has grown to be one of the most popular fixed income funds in Singapore. Thank you for joining us in this webcast. I will now update on the year-to-date performance and the upcoming outlook of our portfolios. Credit markets started the year on a bullish run where risk sentiments were a stark reversal from last year December. So market turned bullish as investors digested lower expectation of rate hikes given a more dovish guidance from the US Federal Reserve. Our exposure in China further added to gains. Investor confidence recovered after Chinese government initiated steps to ease corporate liquidity. This reduces fear of rising onshore credit events. The positive sentiments drove strong returns to our funds. For example, in the first 2 months of 2019, the United SGD Fund returned 1.78%. As at end of February, the fund had a weighted average yield to maturity of 4.4% per annum. Effective duration was 1.58 years. The average maturity rating was BBB+ with 48 issuance. Right now, I will move on to talk about the outlook for the upcoming quarter. Investor sentiment is expected to remain buoyant. This is supported by the US Federal Reserve's patient and flexible approach to rate hikes. In addition, the Chinese government's accommodative policy stance to achieve its 2019 target growth of 6 to 6.5% will support Chinese bond valuations. On the other hand, we are mindful that the JGD composite blended spread has tightened back to levels seen in June 2018. This was when US President Trump began his trade war against China. In addition, the new issuance pipeline is expected to remain active as issuers take advantage of the current market to raise funds for refinancing. Then, trade discussions between the US and China has turned positive recently. However, we like to remain alert to any changes. The negative trade rhetorics from China towards its European counterparts may spell more market volatilities if ensued. Hence, we still favor defensive sectors and we stress on portfolio diversification. We continue to invest in quality credits through management team display a high level of professional management. We also like credits that has leading market share of systemic importance and have a good access to capital markets. Our funds continue to offer stable returns to investors over a 2 to 3 year investment horizon. Well, it's time for the floor and it's QA time. And I'd like my team member, Chia, who is also a portfolio in the Fixed Income Singapore team with me. And let's have some questions from the floor. Okay, we have the first question here. What is your take on investment rate hikes from the US Federal Reserve this year? Will there be none? I think recall that in 2017, we have 3 rate hikes. 2018, we have 4 rate hikes. And of course, this year, people are talking about whether there will be rate hike. I think as a house, we are talking about 0 to 1 more hike. I think whatever that you talk about, whether 0 or 1 hike, is what is very sure that we are at the end of the increasing rate cycle. So, and if you look around, while US economy growth is good, but recent activities in the economy was impacted by the recent shutdown of the government, and China's not doing great. So things are cooling a little bit, so there's not much of inflation pressure going forward. And also you look at December, after Fed did his last hike, market opposed to the rate hike, and Fed is beginning to say, okay, maybe I should just wait around and wait for the last 7 hikes to see how its effect on its economy, to see the data going forward in the next couple of months, to see whether it is necessary to increase hike further. So I think I do agree with the House, it's between 1 or 0 hike for this year. Okay, I have the next question. Investors have very good memory. They said that in the past, I've said that rising rates were actually good for the funds. But now with the fund now, how would the fund now benefit if there's any pause in interest rate? I think let's go to pull out the slides in the past performance of the United SGD Fund. I think investors are very observant in the sense that in 2018 the fund did plateau a little bit in terms of performance. So in 2018 we saw rates rising, we saw tension, we saw concern about China onshore liquidity, and also we saw some fear about the growth of the economy. So all this has, we have digested it all in 2018. So in 2019, we have started the year with higher yield, with higher spread. And that is why we could see that in the last 2 months, we have enjoyed very good returns as spread tightened and as market normalized. So going forward, if we think that if rates are continue to be stable, so I think it will be a year of carry trade. So current running yield is around 3.5, around there, 3.5% in Sing dollar term. So if we are not going to expect large volatility, I think we can take that as a good gauge for a running yield of 3.5% for the next 12 months. Okay, the next question that we have is that, okay, I have more questions regards to the weak returns in 2018, and people are asking then what to expect in 2019. Just to add to what I was saying just now, what were we doing in 2018? Actually, we are enjoying ourselves in 2018 because that was a time where we can get the size that we needed, we can get the yield that we needed. We have people asking us, Joyce, what size you want, what price you want. I thought that was a fantastic time to add into our portfolios. So we did start the new year 2019 with a lot of credits that we liked, and we held on to it. So that is why we think that the portfolio was in a very good shape by end of December 2018, and that's why we are vindicated with the choice, with the selection that we made. That's why the last 2 months we are able to enjoy a good return. There's a sharp reversal for 2018, and sort of like pay back investors' patience with us in 2018. We held on to our fund back in 2018. Right, there's some questions coming in. Do you see spread widening? If so, what are some of the possible contributors to the widening of spread? I have answered some questions. I'll allow Joanne to pick up this question.
Yeah, actually this is a very good question, because last year for the full year of 2018, investment grade spreads on a blended basis widened about 55 basis points, and year to date we have seen a very strong reversal given the positive sentiment coming out from US-China trade talks. So year to date, investment grade spreads have tightened about 26 basis points. So do we see widening from here? Possibly there could be some widening given that there could be, Trump could wage another war this time, trade war this time in Europe possibly. So spread widening is actually not necessarily a bad thing. This is exactly when we like to buy into credits which have sold off to take advantage of the subsequent bounce when spreads tighten back again. So this would be some of the factors that might contribute to spread widening. But given that spreads have tightened so much, like Joyce earlier mentioned, a carry play would be a very good strategy for the next coming months. So definitely to stay invested.
I have the next question. Can UOB SGD Fund invest in high yield bonds? It's a question that I answer pretty often. So just to set the stage, I think we have to remind ourselves that United SGD Fund is registered with the CPF fund, so under which we are obliged that all investment in non-Singapore incorporated companies has to be rated and has to be rated investment grade. Then I can buy into them. But there is a exception whereby as long as it is Singapore incorporated companies, no rating is required. But for our house, we do provide an internal rating for those non-rated names. So usually this is where the possibility of the United SGD Fund investing in the so-called high yield bonds, because high yield as defined by our own internal rating scorecard. So those are typically, okay, those high yield investment, be it rated or be it non-rated but rated internally is high yield, we usually keep at max of 5% for the portfolio, but usually the average is usually about 3% of the portfolio. Okay, next question. Favorite trade idea for the coming year? Okay, let's move to let's have the slide up on the country allocation. Okay, this is the fund characteristic of United SGD Fund. As you can see, where is my favorite bet? My favorite bet is in China, and I think for investors who have seen us a couple of times, we know that China has been also like a signature allocation to China. I always have been a China bull, you may call it. I think I was saying that you grab any 2%, usually there will be one who likes China and one who doesn't like. And I tend to be the other 50% that likes China. Why I like China? I think China still offers a very good risk-adjusted return. If you compare, say, okay, in terms of absolute return, China offers the highest absolute return for among all the countries' allocation. And if you compare it to like China to similar rated like South Korea, also about A band kind of rating, I'm getting almost like 100 basis more. I think in terms of risk adjusted, I really love that space, and precisely that there are the other half of the population that disagree with your bullishness in China. The pricing of China bonds tend to be a little bit wider, and that is the best time where you can find your investment, and that's where you can find your good carry trade. And why I like China, before spending my full time in managing portfolio, I was an Asia financial analyst. So what happened then is that I was sort of like walking through with China how it has evolved, especially in the banking sector, of how much bad loans they have. Then slowly they clean it up using the asset management house, and slowly they list these bank institutions, and they have slowly cleaned up precisely of what the other 50% who are bearish on, thinking about that there's a blow up, there is a lot of non-performing loans in China. And what I like about China regulators is that they don't just listen, they act on it. And they act in a very subtle way without causing very big commotion within the whole economy. You have to bear in mind that China is a big country. You can't really institute something and try to change things overnight. And they're very pragmatic about it. They do things step by step. In the past, we have wealth management products. There was an issue. There was later you have the shadow banking as an issue, and they have slowly addressed this. Slowly, every day, every other week, every other month, you have regulations that come out to address some of the issues that all this bearish camp talks about. And I think in the last 20 years or so, there are so many bearish camp that say there will be a blowout, there will be a crisis, there will be something wrong, and they cannot trust the numbers in China. But look at China, in very good state right now. So I really love China, and I think China will be a good trade not just for last year, this year, or maybe next year, but I think for some time to come. I don't think anybody in the market can really avoid this this sector. Or maybe I'll let Joanne talk about going back to our credit selection process and to say why exactly that even within China there could be risks, but we are mitigating it.
Yeah, that actually also answers the next question on how do you manage the credit default risk in China bonds. In fact, the next slide that we see on the screen actually shows our investment process and how we actually select all the names that go into our fund. Because credit risk is the most important risk that we consider for SGD Fund. And as long as the credit doesn't default, the investors will get back all the coupon as well as principal payments from the company. So key criteria that we look at are basically high strategic importance and government ownership. This actually ties in very closely together to determine the level of government support. Next, we have defensive sector. Being in the defensive sector, we tend to have better visibility on earnings as well as cash flow going forward. Strong capital market access is very helpful for refinancing of debt as well as for building up sufficient liquidity. Next, we have the professional management team, which is very important, especially for private companies, whereby we are unable to access companies' willingness to pay just by looking at financial statements alone. That's why Joyce and we like to meet up with companies to get the management vibes from them, not just to know whether they can pay, but whether they want to pay up. So finally, large market share is important. As you know, monopolistic companies definitely have much pricing power and say in prices and are able to maintain their margins. So all these factors go into our very stringent credit selection process that form the core of our portfolio.
I think it's also good to move on to the next slide about our top 5 holdings. I think that will illustrate how in an exact way that we translate all these theoretical ideas into portfolio execution.
All right, so looking at the top 5 holdings, for example, government ownership and strategic importance, we can refer to our top holding, China Minmetals Corp, which is 100% owned by the Chinese central government. It actually is the largest metals and mining conglomerate in China, and actually provides materials for all the local governments to build their infrastructure and so on. So obviously this is a very strategic and important company to China economy, and you know that the Chinese government will definitely support it. Looking down at the list, we also have Dubai Islamic Bank Sukuk. It's actually the largest Islamic bank in the UAE, and so this company is actually over 30% owned by the government as well, and we do expect government to support it in times of need. So we can move on to the next question.
Wow, the next question is pretty long. You mentioned a carry play being a good strategy for the coming months. However, the Fed rate being higher than 2013, what are some possibilities of having a good carry for local currency and hard currency issuance in a high 200 basis point US dollar environment?
Okay, maybe I can think about it in this way. Right now, for United SGD Fund, we have about close to 90% that is held in US dollars, and about slightly over 10% in Sing dollars. Of course, that said, everything is hedged back to Singapore dollar to minimize the FX volatility. So United SGD Fund is not, while it's Asia focused, it's not limited to investing in Sing dollar as well as US dollar. Historically, we have actually invested across currencies, including Europe, sterling, and even Japanese yen. So whichever we find a good relative value opportunity, we could buy into the credit and hedge everything back to Sing dollar.
More question about concern about the credit. So we have here that there has been an increase in China defaults recently. Does this affect your fund? Yeah, I'd like to pull back our credit selection slide, then we can illustrate why we are not concerned. So let's say if you buy into China credits as government ownership, or we buy into China credits as high strategic importance, I guess it's very difficult for this type of issuer to be in default, because China very much operate on a single balance sheet economy. If you affect one, the other one will be affected. So, and government controls almost every economic lever there is, and sometimes they cannot let go of one thinking that it will not affect the others. So that's something that the government has to consider very carefully. And even for us, when we look into these credits, we are very mindful that these are important strategic issuer, that if everything comes to a crash, these are the sectors, these are the companies that the government will need to fund its resources into. For example, food, national security, electricity, utilities, railway. So it's too important for China to just let this company go under. And when we buy into China credits, it has to have large market share. In China, it's about size. So I think for those headlines that we saw that's having some credit issues, these are typically small companies. These are usually private companies. These can be likely to be in the old economy. As you know that China is moving on into new energy, pollution control. So those companies that are not on the right side of its policy, we do not buy into them. So I think we sleep quite well at night with those credits that we buy.
In fact, investors are getting more used to the fact that it's necessary for China to have defaults to happen, so that what actually emerges are actually stronger companies. Yeah. So maybe you can go on.
Yeah, because I saw an interesting question regarding the SGD Plus Fund, which is Joanne's pet fund. Where is the alpha and risk?
Okay, for SGD Plus Fund, it's actually quite a new fund that we launched back in October 2017. Right now, the size is about 16 million. And just a little bit of background on SGD Plus. SGD Plus is really an extension of SGD Fund, where we actually have the essence of stability of the SGD Fund with an additional plus factor. So the additional plus factor would be the ability to buy into high yield. And so right now, for SGD Plus Fund, we have about 70 to 80% in investment grade and 20 to 30% in high yield. And out of the fund, 50% is actually bought into our underlying unit trust, with 35% into United SGD Fund and 15% into another of our flagship funds, United Asia High Yield Bond Fund. So where the alpha comes from is actually the individual bonds that we buy. For example, for United SGD Fund, as you all know, we can only buy investment grade credits. And for United High Yield Asia Bond Fund, it's actually benchmarked against the Asia High Yield Index. So buying anything outside Asia actually requires an off-benchmark position. But given that SGD Plus Fund is not constrained, it's an absolute return fund, we are able to take advantage of global opportunities. In fact, in UOB, we have 20 over analysts from the developed markets and emerging markets. So the fund alpha and risk actually can come outside Asia for high yield names that we actually like and have high conviction on, as well as taking bets on duration, as well as other investment grade names. So it's really a global portfolio.
I have an interesting question here. Does the size of SGD Plus affect liquidity?
Okay, actually the small size of SGD Plus is actually very positive for liquidity. In fact, it's very easy to trade in small sizes because it doesn't really affect the market price as well. As you know, if you were to trade 2 million versus trading 10 million, 2 million is very easy to trade in and out. So actually the fund year to date has been very active, especially in the high yield space, given that we have seen a lot of high yield issuances lately. So it has been having a lot of fun actually trading in and out.
I can see question coming in. Will MAS increase the slope in April? We just had our quarterly strategy 2 days ago, and the thought is that in April they will not change. So why? Well, you see that Federal Reserve has already paused, and around Asia a lot of economies has also paused, and some are even cutting rates. And so I personally agree with the House view that there won't be a shift in the slope. Also, you can see that from the recent Singapore data, it's not looking great except for employment. So if you look at Singapore economy slowing down, industrial production slowing down, GDP growth, even the government has also come and say that their expectation is likely to be in the middle of their expectation. And inflation is also showing some downward drift. So there's really no reason to change the slope. I suppose the question means slope changing it steeper. So I suppose there will be no change. It will be likely to be status quo. Okay, another question on Plus. What is the running yield of United SGD Plus?
Okay, currently the running yield for SGD Plus is about 6.2% on a gross basis. In Sing dollar, it could be a mid 5%. And our dividend payout is actually targeted at 3.6 to 4%. So that is an adequate margin of safety, as you like to put it. Besides the running yield, we also get alpha and capital appreciation from existing funds and existing bonds in the portfolio, as well as the additional income we get from our alpha trades.
Okay, we have questions on investment grade China. What is your view on China investment grade, especially in view of recent report of many hanging on the cliff waiting to be downgraded to high yield? I would say this question more relevant in the last quarter of 2018. In fact, things has changed a lot, as I described, a stark difference now relative to then. I think in 2018, China government was very stringent about keeping all these non-surviving corporates away from the proper working of the economy. But as they reduce the leverage extended to these hanging on the cliff kind of companies, they realize that they are impacting the entire market. So like what I mentioned just now, that China works on a single balance sheet. So when they cannot just look at one, affect the one, and thinking that the rest are not affected, and the market is showing that that is not possible. So interestingly, actually by December, there's really the door started to open, and they realized that they need to start to give liquidity to even the private companies. So things have started to open, and you open up even more into this year. And you hear about NDRC approval. Last year, there's not many lines on the NDRC approval list every month when it's being published. But as towards the December, there were a lot more allowance given to these companies. And recently, when we met companies, they say getting NDRC approval, not an issue. So leverage has come on, the water has turned on for them, so liquidity has started to flow and things are looking fine again. So those companies, there was some concern about the high yield going to some liquidity issue, and less of the relevance now. But let's say, going back to the slide, how we do our credit selection, I guess then again, even if there are credits that is really going to be downgraded, we are unlikely to be there. Ooh, okay. More questions on China economy. Do you think of the most recent Chinese stimulus announced? What do you think of the most recent Chinese stimulus announced? Sufficient to turn back growth? Maybe I want to dissect the question a little bit and to look into perspective. I think the last time when China really did their stimulus, they have learned their lesson and they have resulted in more zombie companies and companies that are not supposed to be there and they were there. So China is not unlikely to open up floodgate and stimulate the economy irregardlessly. So, and if you notice that the recent meeting that they have slowed down their target growth 6 to 6.5. I personally think that it is a very pragmatic range, and China being China, if they want it to be at 6 to 6.5, they are likely to be there. But I think China has a mindset change in the past where they are very much into driving into growth, but now they are driving into quality growth, which is more sustainable. And I think an economy that grows 6 to 6.5 is still relatively good for the economy to really sufficient to turn back growth. In fact, 6 and 6.5 is growth in itself, so it's quite a respectable growth. So I think it should be fine.
Just to add to Joyce's comment, if you compare the current stimulus versus the previous stimulus was very much focused on the state-owned companies, whereas this time the China's stimulus is actually pretty much broad-based. We have monetary policy in terms of RRR cuts to provide more liquidity to the banking system, as well as having fiscal policy such as tax cuts to corporates to spur investment, as well as personal income tax to spur consumption growth. So in this sense, it's a very broad-based and holistic type of stimulus, and we expect that the government's focus is not so much on growth, but more on stabilizing the economy, and I think that this is a very prudent policy approach by Chinese government.
Okay, we have a specific questions on corporates. You have 12% in UAE exposure. Could you talk about that? I would say UAE, I've been to UAE a couple of years back, and one thing like a key takeaway is you must have very good karma to be born as a Qatari, because when you're graduated, you get like 12,000. Sorry, okay, don't worry about that. But there are, one interesting thing is that if you get married, the government actually gives you a house. So it's really a very rich place. And when I was driving on the road, I saw wedding, and I was asking why do they put out a big wedding banner outside their house. The Qatari guy was telling me, they actually invited the whole city to come to their wedding if they want to. So it's a very rich country. But what is interesting about the place that I think similar to China, there are some challenges because of geopolitical issues, that maybe a bit of quarrel here and there among the brothers. So there is some volatility, but that's where we can find risk-adjusted return. So when we look at UAE, we focus on the richer places like Qatar, Abu Dhabi, Dubai, and we avoid places like Bahrain or those or even like Saudi Arabia. So I think those does give us a little bit of alpha within the portfolio of United SGD Fund. Are you concerned with the risk of a synchronized slowdown recession, which may seem to say is coming in 2020? Again, this is a question that can be more relevant last year, but this year has changed. Precisely that like I said, this question is more relevant last year because Fed seems to be like wanting to do their increase. Then they realize something is wrong. They need to pull back a little bit by December. They started to say, oh no, okay, we will watch the data from now on. So precisely of their change in their stance in the Fed rate that they say that now they're going to pause, recession seems to be pushed back. So if they have continued to increase their rate then into this year, we may possibly see a recession, but precisely they have stopped, we are likely not to see a recession. And for a slowdown, are we afraid of a slowdown? Okay, maybe I'd like to pull out that slide on the past performance again. Okay, when you talk about slowdown, when you talk about crisis, when you talk about spread widening, when you talk about increasing rates, these are, some people may see, oh, bad market, but for us, we're actually very happy because market will correct. That means spread will widen. I can buy bonds at wider spread, and if market really slow down, people are fearful about the outlook of the company, then of course I'll avoid those companies that really will suffer and struggle in the time of slowdown. But remember back again when we talk about how we choose our credits, typically are those that are non-cyclical. These are infrastructure, these are big, these are food, these are utility, these are railway. I think in a slowdown, it's unlikely to affect those companies that we invest in. Market can slow down, economic can slow down. I think within the portfolio, we have curated very good quality bonds that investor can also sleep well with us, that they should, if they hold an investment horizon between 2 to 3 years, they will definitely see a positive return. I think for the fund itself, we have never seen negative return except for once, and even for last year, through the difficult times, we still managed to stay above water. What is your view on duration position moving this year, especially second half? I think that's an easy question.
Yeah, actually, for United SGD Fund, given that we are very focused on short-dated investment grade, actually duration does not really play a part. In fact, credit selection is the most important for our fund. And United SGD Fund buys into credits up to 3-year maturity. So any credit that is in 3-year maturity and investment grade can fall into our investment universe. That said, we do have a house view in terms of duration, position, and we are pretty much neutral in terms of duration, given that we're not expecting Fed to hike anytime soon, if not one time, if at all. So neutral position is very much where we are.
We have question again on sector country allocation. Could you talk about how your sector country allocation has changed over the past year, if at all? Country sector. Okay, I mean, it reminds me of someone who told me that Joyce, your presentation is too short. It's not enough pages. But I'd like to remind investors that United SGD Fund, even for Plus, United SGD Plus, runs on a very simple strategy that we basically have short duration. We have a short-term 3 years, 5-year view about the company, and we just buy the credits that we think that makes sense in terms of risk-adjusted return, and we just get it onto our portfolio. And about 80% of the portfolio, that will be our core, with the rest of 20% that we trade. So we do not really, we are very mindful of sector and country diversification. I think the only sector or only country allocation that I'm very mindful of is my China. I'll try to keep around 35 to 40% in China, and hopefully try to diversify the rest of the portfolio in other countries. And if you look at the countries, the ones that is giving me more yield is China, UAE, and the rest is more like trying to play a barbell strategy where I have the alpha, which is driven from China and UAE, and the rest forming the core portfolio that gives that stability of the portfolio at all times. So that although I have 48 issuance in the portfolio, I don't watch all 48. Possibly I just watch about 5 credits that I tend to pay attention more. So I think, and when we buy into the portfolio, we don't like I say, we keep our 80% as core position, so you do not expect a lot of change. The percentage allocation, be it on sector and country, tend to be quite consistent. You can always track back. With all our monthly fact sheet, they are likely to be quite steady. I think the only change you could possibly experience is my ups and downs that adjust the China exposure, because sometimes I may want to take profits. Like I think within the last 2 months, China was maybe up to like 37, 38%. Now it's down to about 35, 36 because I took some profit. I'm keeping my bullet dry. As we mentioned, spread has tightened, yield has come off a bit. So we're just looking around if there's any good opportunity, like we always do, keeping some bullets dry and pounce into any opportunity that comes by.
Yeah. Like Joyce mentioned, given that it's not a benchmark fund, it's really an absolute return fund, SGD Fund can essentially buy into anywhere we see value. So for example, there was some time back where we saw value in US investment grade names. We did take the opportunity to buy into them because the credit spread differential between Asia credit and US credit had actually narrowed, so we bought into US credit. And then when the spreads actually widened back, we bought back into Asia credit. So it's a very flexible approach. We don't have a predetermined set country allocation in mind before investing. Yeah.
Okay, we have questions coming in fierce and furious. Next question we have is market were pricing in a Fed rate cut late last year. Thoughts? Again, it's a question more relevant last quarter. So I think things has really a lot reversed this year. Yeah, indeed that market was expecting a cut even before now. So right now is we have seen the Fed not going to move, and currently market has reverted to expecting a stable Fed rate for the entire of 2019. But I think that US is still growing well. So again, back to what we were saying, that there is a possibility of one more hike, but don't be surprised if there's really no hike like what the market is expecting. Well, we have come to the end of the session. Thank you for joining us today for the great question polls. If you have further questions after this session, please get in touch with your client relationship team. Thank you.
Thank you.